Thank you very much for the award and for inviting me to give this presentation. I'm honored to be here. I'm going to tell you about my research, and much of my recent research is inspired by the financial crisis in the US, which you might have realized created a lot of damage also in the non-financial sector. And if you think about problems in financial sector, they're often associated in one way or another with uncertainty. And uncertainty typically comes with belief disagreements or differences of opinion, as Mr. Shine referred to. Now, when things are uncertain, people also naturally disagree about. For instance, people might have different views about what the stock market is going to do, whether house prices are going to go up or whether they will go down. And the organizing theme of my research is uncertainty and disagreements and their effect on financial markets, in particular on asset prices as well as financial contracts. So I'll try to today give you a flavor of some of this research. And let me start by the effect of belief disagreements on asset price. Now, if you start with the view that people have different beliefs, that means that some people are more optimistic than others. And under some reasonable assumptions, they will be the ones that are actually buying the houses or the stocks because they value them more than the other people, the other investors. And if these optimists are sufficiently optimistic, they will start beating up the price of the assets and generating something what economists sometimes refer to as an asset price bubble. Now, this picture on the slide shows you actually two asset price bubbles. What it shows you is that if you were to put your money to buy a house, let's say in the beginning of the period, and then collect rental income, and then sell your house at some point in the future, the black line shows you what return you would make on that investment. As you see, in the first half of the period, you would make considerable return because house prices over this period were going up. But later, as you see, you would make a considerable loss because house prices collapsed. So the black line essentially illustrates a housing bubble that later burst. And the pink line illustrates a similar bubble that burst in the stock market. And these plots might look very familiar given what happened recently in the US. But if you actually look at the x-axis, you're going to see that they're not about the recent years. They're about 1920s. They're about the roaring 20s in the US, which featured a stock market bubble that later burst, and which was one of the triggers of the Great Depression that followed. And a little less well known, there were also local housing bubbles that burst at the time, and the black line is a bubble in Manhattan real estate. Now, history has a tendency to repeat itself, so when we come to more recent years, you're more familiar with this. We also see now we had a larger scale housing bubble now at the nation level in the US, the national average level, that later burst starting 2007. And an interesting aspect of this bubble was that people who were buying houses actually often were buying not with their own money, but they were buying with other people's money. They were buying the houses on credit. Right? The pink line here shows you that a subprime home buyer, someone with low income, could actually, at the peak of the bubble, could buy a house by putting only 3% of the price out of her own pocket, getting the remaining 97% from a lender, let's say a bank. And the same picture shows you the situation was very different when we come to the crisis, let's say 2008. Now, a same type of home buyer would have to put up more than 15% of the price out of her own pocket. She was able to borrow much less from a bank. Now, the question raised by this graph is why? Why was it very easy for optimists or home buyers to buy houses at the peak of the bubble, and why did it become much more difficult afterwards? That's one question that I address in one of my recent papers. Now, and to do that, I construct an economic model. Now, in economics, unlike some other fields, we don't get to do experiments very much, especially when the phenomenon is at the macro level. You cannot really address it by doing experiments. So instead, what we do is we build models, and then we do thought experiments using these models. So I did some thought experiments in this context, and here's what I learned. I learned that the availability of credit, whether credit goes to home buyers, depends on the nature of disagreements, nature of uncertainty. What do I mean by that? Let's go to 2005. And at 2005, let's say, people generally agree that house prices cannot fall very much because they haven't fallen at the national average level for a long time since the Great Depression. Home buyers, banks are like, nobody really thinks there's going to be much action on the downside. Suppose the uncertainty is mostly on the upside. Let's say people disagree about how good things can be. It could be that home buyers think house prices will continue to go up because they've been going up recently. Banks are more cool-headed. They realize that house prices will perform according to their historical performance. There is disagreement, but disagreement is on the upside. Now, I show that when we're in this type of situation, when we focus on the upside, credit is very easy to flow to optimists, so the higher valuation buyers. Why? Because even though banks are not that optimistic, they're happy to extend credit because they think nothing too bad will happen. Right? And as this happens, money gets to the hands of the optimists, and optimists are able to bid up asset prices, which further exacerbates and raises up and contributes to the bubble. Now, when you go to 2009, now the situation is very different. Now people are really focused on bad events because something bad already happened. Now, perhaps the question now is how bad things can get. Optimists are the guys perhaps who think it's going to be a garden variety recession, and pessimists think it could be a repeat of a Great Depression. Now, I show that when the uncertainty is on the downside, when the disagreements are on the downside, the situation is going to be very different, and it's going to be very difficult to get credit in the hands of the optimists. And because optimists cannot buy houses on borrowed money, it's going to contribute to the collapse of the bubble. So what we learned from this research then is what investors are uncertain about, what they disagree about, also matter a great deal for financial contracts and asset prices, perhaps more than how much they disagree on. Now, the next thing I want to talk about is the idea that belief disagreements also make individuals naturally to speculate on to bet and speculate on their different views. Now, to illustrate what I mean by this, let me tell you actually a true story of two famous economists. One of them is Joe Stiglitz, who has a Nobel Prize, and the other is Bob Wilson, who's a very famous economic theorist. And the story takes place at Stanford University in the 1970s. They're sitting on a couch, and there's a pillow, and they disagree on what this pillow is made of. Joe thinks that it's made of cotton, and Bob thinks that it's made of polyester, and they want to bet on their different views. Let's say they each have $100 in their pockets, and the pillow costs $50. Now, they want to bet on their different views. They construct a bet. There's a problem, however. To find out the winner, they need to cut the pillow open. Right? That's the only way to find out what this pillow is made of. And let's say they agree to split the cost of the pillow, each one paying $25. And if you think about this situation for a second, you realize that they actually want to do this bet. Because Joe thinks that he's going to win $100 from the bet, and he's happy to pay the $25 for the cost of pillow for a net return of $75. Now, Bob thinks that he will win $100 from the bet, and he is happy to pay the cost and for a net return of $75. So they both think they're going to win, but now I don't know the end of the story. Hopefully, they were sensible enough not to go ahead with this bet. But if they did, here's what would happen. You would have money transfer from one party to the other. There would be nothing produced, but you would have a perfectly good pillow being destroyed. Right? This looks like a worrisome outcome. What I do, it might look like a stylized. And essentially what's going on here is that because people are going again after speculative gains, they're going after gains based on their different views. They think they can each win. But we know that there could be at most one winner, right? So when they're going after these speculative, illusory gains, along the way, they're also destroying tangible stuff like pillows. Now, this might look like a very stylized example, but what I do in some of my recent research is I identify areas of the financial market that can be conceptually mapped into this example. So I dig out destroyed pillows in the financial market. Let me give you an example of what I mean by that. Financial innovation. You might have heard a lot about this recently because it's essentially the idea of introducing new assets into the market. For instance, these mortgage-backed securities, their derivatives, CDO, CD, all the complicated stuff that you read in the news. This is called financial innovation. The general idea of these innovations is to increase the trading opportunities in the market, so to make people realize trades which they couldn't realize before. And according to the traditional finance theory, the financial innovation should be useful by enabling people to handle their risks better and to reduce their risk. It might sound a little strange because we know what happened recently. A lot of the large financial institutions, for instance, AIG, realized losses and got into trouble precisely because of their positions in these securities. It didn't look like it helped them manage their risk very well. So what I do is, motivated by some of the observations of the recent crisis, I reconsider financial innovation by allowing people to disagree with one another, just like the example with Bob and Joe. And if you make financial institutions disagree with one another, naturally they start speculating and betting against one another. And naturally, just like in the Bob and Joe example, they start generating risks which they didn't exist before. And if you think people dislike risks, as we know they dislike, they're happy to pay for insurance, these additional risks actually effectively are welfare reducing. They are the conceptual analogs of the destroyed pillow in the earlier example. So what this research then suggests is that financial innovation could actually has a dark side to it. It could end up increasing the risks in financial markets and bring instability to financial markets. So let me conclude. I don't want to take away from the time from other researchers. So as I tried to describe, the organizing theme of some of my research is uncertainty and disagreements. And among other things, these ingredients can help us understand some aspects of the recent crisis. For instance, they can help us understand how disagreements can generate asset price bubbles financed by credit, and how financial innovations on securities, which are ultimately backed by the bubble asset, could actually increase the risks and further exacerbate the crisis. Thank you very much.